Hello, I'm Sean Lim, and welcome to After 10. There's a new term out there to describe the U.S. bond tapering program, Tapernomics. How will it affect Korea's economy and the global economic recovery? On tonight's After 10, we meet with one of Korea's leading economic experts. Stay with us.
The world financial market has encountered fluctuation on the U.S. Federal Reserve's decision to taper its quantitative easing. Ben Bernanke, the former chairman of the U.S. Federal Reserve, decided to reduce the quantitative easing at the end of his term. And new U.S. Fed Chair Janet Yellen suggested she would continue promoting the tapering in her first speech after taking office.
Purchases are not on a preset course, and the committee's decisions about their pace will remain contingent on its outlook for the labor market and inflation, as well as its assessment of the likely efficacy and costs of such purchases.
With the world economy moving toward tapernomics, there have been growing concerns about the effects in emerging markets. The Korean government has been searching for methods to cope with the rapidly changing global financial conditions. We discuss the current situation facing the global financial markets, along with the U.S. stimulus tapering, and what kind of measures should be taken by the Korean government.
Well, Professor Yang, thank you so much for joining us here tonight on After 10.
Well, thank you for having me.
Well, we started off 2014 on a bit of a shaky note in terms of the financial markets, especially after the U.S. Fed's Open Market Committee announced another $10 billion pullback in their bond tapering program. Why do you think that had such a huge effect on the market when we were expecting a tapering?
There's no surprise. If a government or a company fulfilled the plans that they announced earlier, this type of shock wouldn't happen. This time it did. I think it reflects the very nervous nature of the global markets right now. A lot of people are mentioning that the trigger for this instability was some less than expected. It's not bad, but less than expected numbers coming out of United States and China. But I think because the global markets are so nervous, that had an amplified effect. Now, the reason that the markets are so nervous is that we're undergoing the tapering, phasing out of the third stage of the quantitative easing. And something like quantitative easing at this scale, it has never been done before. Usually, the central banks try to control the short-run interest rate using buying and selling short-term government bonds. But for this time, 2010, 2011, the United States Fed thought that it wasn't enough. And the reason is the Fed usually makes its policy based on something called the Taylor rule, which is you set the interest rate on a combination of how much unemployment there is and how much growth there is. So, and a lot of academic economists are saying that if you try to calculate the Taylor rule, the Fed doesn't announce exactly what type of rule it uses, so it's a guess. But a lot of academic economists felt that if you calculated the Taylor rule interest rate, it would have been negative. So obviously you cannot set the short-term interest rate below 0%. So their solution was, let's try quantitative easing, which is buying not the usual short-term government bonds, but long-term government bonds and private bonds, which are much more risky. And they bought these unusual bonds at an unprecedented scale. So this has never happened before in modern economic history. And then we have the tapering, which is phasing out of that. So we're really treading on some unprecedented ground. There's no reference to refer to. There's only some theories and ideas. So I think that's making the entire global market so nervous.
So if there's no reference to benchmark in terms of how to really implement this program and then wean yourself off of it, what were some of the factors that went into play in terms of the U.S. Federal Reserve deciding, okay, now is the time to scale back?
Most important variable that they said they were looking at was the inflation rate and the unemployment rate. And the target that they kept on mentioning over and over was 6.5%. Now, at the beginning of last year, it was on the high end of 7% range. So the Fed thought that there's a realistic goal of hitting 6.5% within the next 12 or 18 months. That's when they would have started the tapering. And everybody expected the taper to start in the middle of the year, but the Fed was not convinced. Then they started at December. Now, the current U.S. Unemployment rate, the latest number is 6.7%. So in that sense, they're doing exactly what they said they would do at the beginning of the last year or even before that.
So the U.S. Fed has also decided to keep its low interest rate policy alive. What's the reason behind keeping the interest rate low even though we're tapering back on the bonds?
Okay, well, the academic way, technical way of, I guess, looking about this is I mentioned the Taylor rule earlier. A lot of people thought that if you calculated it using the Taylor rule, the short-term interest rate should be negative. Those economists are still saying that it should be negative, but it's fairly close to zero now. So it's time to phase out the extraordinary measures, but not necessarily time to phase out the usual measures, because even if you are using the Taylor rule as a calculation, it's very close to 0%. The non-technical way of looking at this is while the unemployment rate is recovering, it's still not very good. The United States considers the full employment rate to be somewhere between 5.0 to 5.5%. And the inflation rate is still very low, and it doesn't look like it's going to accelerate anytime soon. So there's no reason to raise the rates at the present, and there's still some reasons to maintain the low interest rate to try to improve the unemployment rate even further down to somewhere in the 5.5% range. This is why they promised to have very low rates until they hit 6.5% and probably a lot longer than that, because they want to make sure that the recovery catches on.
So Janet Yellen took over the reins from Ben Bernanke over at the Federal Reserve. What do you make of her first announcement and a statement of her policy objectives?
I think the Fed realizes that the markets are very nervous. So I think the most important thing about this first announcement as the potential chairwoman is there were no surprises. She said that they were going to keep on Bernanke's script. They're going to stick to that script. And unless the things I've just mentioned happens, the inflation rate is seems to accelerate, or the unemployment rate falls much faster than currently, then they're going to stick to that Bernanke plan. And I think that was meant to reassure the markets that we will not pull a surprise unless we are forced to.
And what about some indicators from not only the United States, but from China in terms of their economic activity? How do all of these reports on manufacturing or consumer confidence really go into affecting the rate of our tapering?
One of the reasons that we had a very scary January was that the U.S. unemployment numbers, the U.S. sales in the last quarter of 2013, and the Chinese manufacturing numbers were not as good as everybody thought it would be. I should emphasize that the numbers themselves, they're not that bad. It's just not as good as people expected. So as I mentioned, the U.S. unemployment rate is 6.7%, which is more than 1% down from last year, but people had too optimistic an expectation. The sales numbers were not as high as people expected, but they're not too bad. The Chinese manufacturing, okay, they contracted a bit at the end of last year, but the latest export figures shows that they're actually exported a lot. So I think the Fed realizes this, and every central bank realizes this. What's important right now is reassuring everybody that things are stabilizing.
Developing nations saw a lot of instability in their financial markets. How are they doing now?
They're bad but stable. I think that's a good way of putting it. The so-called Fragile Five countries that everybody's been worried about last year, India, Indonesia, Turkey, South Africa, they have a current account deficit, so they're losing dollars, and they have high government deficits, but their numbers are not bad enough. Usually, if you have numbers like that, you would have a recession, but not necessarily a financial crisis. But because the markets are so nervous, I think they're worried about whether they'll have a crisis there. Countries like Argentina, Kazakhstan, which just recently devalued their currency, those countries have some very bad variables, but other variables don't look that bad.
Despite the U.S. Fed's decision to taper its bond buying program, the foreign press has been positive about the Korean economy. However, we can't overlook the expected challenges. What kind of measures should Korea take in order to deal with the stimulus tapering?
So how has Korea been responding? Our finance minister says, and has been saying for quite a while, that the tapering program in the United States will have a limited effect here in Korea.
Yes, so let's look at the numbers that people are worried about when they talk about potential foreign exchange rate crisis or even a very large change in exchange rates. You look at factors like, does this country have a current account deficit? We don't. Do we have a lot of short-term debt? The ratio of our short-term external debt we owe to foreigners to total foreign debt is about a third. That's very good. Further, we have enough foreign reserves to cover all the short-term external debt, plus 3 months of imports, and we still have some money left over. So in terms of reserves, we're prepared. In terms of numbers that are not quite good, you look at government budget deficit, and if you define it widely, then Korean budget is in a deficit situation, but it's not too bad. And our our debt to GDP ratio, the total debt, is also not that bad. There's some worries about household debt, and that's on the high range, but if you look at all the variables, then we have a lot more good variables than bad ones, which is why I think the government is emphasizing that we're in a very good situation. One of the things that we want to emphasize by using these numbers is that we're in a very stable, solid situation. Even if a problem happens, we have enough resources and tools to combat that, and that helps create investor confidence so that we don't get into that psychological trap that I talked about earlier.
So the balance sheet of Korea looks pretty good in terms of weathering a crisis. But experts have also pointed out that on the upswing, when the economy turns around, Korea is going to be in a very beneficial position, and it should be one of the top countries to invest in and keep your eye on. Why is that? What factors really give people optimism?
If you look at it as an international investor looking for a short-term return, we're actually a fairly good place to park their money. The advanced countries' return isn't very good, and the emerging economy seems too risky, then we're a good place to put our money in. Now, the problem is, if the emerging countries' returns go up or the emerging countries seem safer, then it's a good place to move the money back out since it's only parked here. Similarly, if the returns of advanced countries' safe assets go up, then they'll take the money that's been parked in Korea and bring it over there. So we're actually in a place which is good in terms of real economy, but in terms of international finance, it's open to a lot of instability.
So 40% of our exports go to emerging economies, and we've talked a little bit about the instability over there. Do you think the financial instability in their markets will start to affect the real economy in terms of our export relationship with these countries?
Okay, obviously, if a country gets into a foreign exchange crisis, we cannot export there. So there will be some definite effects there. But all the problem countries that we've sort of talked about here, emerging economies which are in problem, Fragile Five countries, Argentina, Kazakhstan. If you add Korea's exports to all those countries together, it's about 10% of Korean exports. So if crisis remains in those countries and do not go regional, as I personally think if there is a crisis at all, it will be limited to one or two countries, then Korean exports will not be that much hit because most of these countries, the share of Korean exports going to those countries are so low. Now, that doesn't mean that we'll completely escape any negative effects. Korean government has set a growth target of 3.9% this year, which is a very ambitious goal because most private projections are less than that. It's in 3.3 to about 3.7 range. So if we have problems in some countries, then it'll make it much harder to meet those goals. But will it cause a large recession in Korea? No.
Well, President Park Geun-hye has called for a reform of the domestic economy, especially when it comes to preparing for external shocks. She wants to build up the domestic consumption and also change us to a creative economy paradigm. Well, what do you think really needs to happen in Korea for us to go down that path?
It's going to be very difficult for Korea to avoid international economic situations completely because we're just so dependent on exports and imports. We need to import a lot of raw materials and intermediate parts for us to export effectively. I think what we can do, though, is if we have what we would call a high value-added product. President Park is calling those knowledge products. If you talk about economists, then they probably are goods like, say, smartphones, which other countries cannot really make because they require a certain level of technology and inherent creativity that is inherent in the good. Then we can weather these recessions better because since Korea has, if not a monopoly, then at least a very large part of the market, we can weather. Even if the global demand falls, the demand for these products will not necessarily fall as much. So I think that's what President Park wants Korea to develop into. That's what Japan had during the 1980s and early 1990s. Also, things like the Korean-US FTA, by making the Americans, it's making it more difficult for Americans to impose trade barriers, by encouraging more foreign direct investment inside Korea. As I mentioned, the foreign direct investment is more long-term investment, so that's the investment that tends to stay in Korea and really change the Korean economy. So those type of investment will be encouraged. So having things like that hopefully will help us not completely escape the effects of global recessions, but hopefully allow us to weather it better, reduce some of the worst effects.
So the Bank of Korea Governor Kim Jung-soo is going to be stepping down and passing his baton over. What should the new Bank of Korea governor really focus on?
Okay, I think it's on the upswing that we just talked about. I think managing the upswing is actually more important than managing the downturn. Because once an international investor gets in a panic, I think the last decade has shown us that they will have a large flight to safety. They will, even if the country is probably safe, if they get an idea that, well, this country has a fairly good chance of getting into crisis, then let's just take the money out, put it in dollars for now. So when the money is coming into Korea, that in the short term, I'm not talking about the long-term foreign direct investment, FDI type of investment, but short-term stock market-based, bond-based investment, then that money, because Korea is such a good place to park, it's money that's potentially going out very quickly. And once you're in a panic situation, no matter what kind of policies Korean government may institute, I don't think they'll convince people who are in a panic, because they can always say, well, let's take it back out and bring it back if the situation stabilizes. So money, we can't really control money going out, which means we have to take any prudential measures when the money's coming in. And that's politically unpopular, because you're basically saying that you don't want the stock market to go that high.
So as we look ahead to the rest of the year and we see Tapernomics take its full effect, what should we really be paying attention to?
If nothing really good or nothing really bad happens, if things continue on this current path of recovery, then I think you'll see no big surprise. And the tapering will end somewhere very late this year or early next year. The next big hurdle, next big chance for instability, I think, is when the Fed has bought all these long-term bonds, it has bought all these private bonds. They're going to have to sell it. And what happens if they actually start selling all those bonds? I think that's going to be the next big instability that I can see at this point, but that's not going to happen until next year at the very earliest. Now, if some of those problem countries that we mentioned do get into a limited financial crisis, then again, you'll see a lot of instability. And that will obviously have a lot of negative effects for Korea, but I think there will be short-term, a few weeks at the longest, because I think those crises, if they happen, will be limited to those very few problem countries.
So if everything goes as planned, it's just slow and steady this year?
I think that's the best we can hope for. We may get lucky and have better than expected year, but realistically, what we can hope for and what we can get is slow and steady.
All right, well, thank you so much for your insight tonight.
Okay, thank you.
And that does it for us here at After 10. Join us again next time. We'll see you soon.